Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, regulatory landscape, and capital markets. This segment is presented by Charles Schwab. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site, we have Max Cabasso, Managing Director on the Nasdaq Market Intelligence Desk, Dr. Preston Cherry, Founder and Wealth Advisor at Concurrent Wealth, as well as Ruth Crowell. She's CEO of LBMA. We're here to discuss the potential impacts of rate cuts across asset classes. It is great to have all of you with us. Welcome back to Trade Talks, all veterans of the show. Yeah. Max, we're here. We're rate cut week. And what's the market thinking? How do you think it's going to digest it? What are the chances?
I think it's going to be more about the Q&A after, and the press conference after, than the cut. We're at 100% chance of 25 basis points, 5% chance of a 50. I think the 50 would be a major shock. 25 is expected, but market right now is still pricing in another 25 for the next cycle and another 25 in December. So market right now is looking for 75 bips total by the end of the year. How we get there is going to be the big key. And what they're saying, is it a hawkish cut? Is it a dovish cut? What are they saying? We obviously saw in the last conference they essentially got rid of the 2% mandate. Is there anything else that starts to come out that changes the thought process of the market? Because right now it seems like autopilot 25, 25, 25. If we're sticking on that track, I think volatility will remain low. We've seen it's very low right now. If we get some commentary after the fact, that's what might cause a bit of gyration in the market. Yeah, well, we have to address the obvious elephant in the room, Ruth, and gold is performing considerably well, as are stocks that are staying at all-time highs as well. How do you think investors should view gold these days? Is it a store of value, inflation hedge, safe return, performing asset? Is it a little bit of everything?
Well, I think it is a little bit of everything, but I think that history has shown us certainly its role as a safe haven asset, as well as a store of value. But I think what's happening now, as we've seen the gold price really just continue to climb, not just this year, but been ongoing for quite a while now, is that people recognizing its value in the portfolio on an ongoing basis. You've seen the gold price go up, it's nearly 30% from January this year, but actually since the beginning of the millennium, we've actually seen an 11% increase year on year. So what we see is gold is having a moment, but it's something we in the gold market have known a long time. I think it's that opportunity to get involved where people had maybe engaged previously. Yeah, and Preston, I mean, the obvious other elephant in the room is the stock market and its valuations, sitting at pretty frothy valuation there.
Yeah, so the stock market is doing its bull thing. But the people are asking, I hear a lot, it's like, how can the market be doing its bull thing, but the economy is doing its thing, right? And I think we hear bulls, and it's not doing a bear, but the economy is doing I think a bunny. It's just hopping around a little bit, because to your point, Max, the Fed cuts are 25, 25, 25, which that's an outlook of, the economy just doing a steady as they go type of thing. And any type of headwind could shake that up at any given time. I mean, the economy is tepid at best. I mean, we have slow jobs growth. The wage growth is just a tad bit over inflation. So all these signals are just okay, and that's a bunny hop. But the markets are doing well. So households are staying invested, but they're also cautious of what's in their refrigerators and their decisions as far as their household decisions.
Yeah, which is so interesting because it's a good lesson here, Max, that you have to recognize the market is not the economy and vice versa, because your consumer behavior could look very different than what your 401k might be indicating.
100% assets are doing very well. They have been doing well. Underlying, not as great. Also, we've talked about it a number of times in the show, kind of depends on the subset of consumer you're looking at, job holders you're looking at, almost that K-shaped recovery. The top 10%, top 1-5%, the ones that own assets, you're not feeling it as much. In the day-to-day, you're feeling it more. We see it in the jobs number, the wage growth. It depends who you're asking where you think the economy is going, and it's not the same economy for everyone, and that's what we're seeing. When you see the market, again, those that are asset owners, whether it's gold, housing, stocks, they're doing really well. You're seeing your 401ks appreciate. Things are not so bad. You're seeing, my numbers are going up. Now, if you're not invested in those assets, you're not going to have the same story. So again, it kind of depends where you're looking and what's going on underneath the surface. Because again, we've talked about it a lot recently, is the performance in the market has really been concentrated. We've seen it sort of get a bit more better breath, but IPO market is open, so there is demand for other assets, but The big have continued to get bigger and bigger, and the small caps are really been rate dependent, and that's what you're seeing. If we get that cut, you see that small cap outperformance, and they're really depending on that, whereas the large caps have continued to outperform because their fundamentals are solid and there's the spending. It's kind of the same in the economy. The ones that have are doing great. The have-nots are really kind of waiting for that rope to grab onto.
Yeah, I mean, if your fundamental thesis is on 25 basis points for a small cap stock, I think there's bigger issues there, and we've seen that continuously for at least 2 to 3 years now at this point. I also want to address Max's favorite trade, Ruth, silver. I mean, that's an extraordinary run as well. What are some of the fundamental reasons behind that?
I mean, I think for silver, we're up 43% since the beginning of the year. It is all-time highs. I do think there's a few things going on. I mean, it tends to follow the gold market, but the other aspect is industrial. So there is a lot of purchasing from solar energy, something that the industry has talked about for a long time, but actually has really started to happen now. So one, there is still some sensitivity to that. But I think it's poor man's gold in some sense. It's a way to get exposure to bullion without going to, $3,695 an ounce.
Yeah, well, I mean, it's interesting. I did not know this, and another guest had brought it up, that there's over 10,000 industrial applications that silver can be used for. I mean, that was quite astounding. So clearly another beneficiary of the AI trade and demand for energy and so forth. So Preston, in this environment, how are you advising clients? Stay invested, because again, to your point, they might perceive the economy different, but if they've been staying invested, there's a reason to, move out of those investments if over the long term they've been performing.
Yeah, and to Max's points I made, have and have-nots, but even the haves. I've heard conversations from the haves. I mean, the family offices are still, they're still staying on the sideline as far as putting cash to work. I've received calls from folks that are trying to raise private money, and they're saying, okay, well, let me stay on the sideline. I don't want to allocate that much. And even consumer staples right now, I think that's one of the, not the worst performing sector, but they're in the middle. I think maybe down 1.5, something like that, the last couple of months here. So that means people, even Costco, I think it's doing okay right now. It's had a good year, but for the last few weeks. So people are being cautious right now. So that's another, when I say alliteration, being cautious right now with their money as far as their big ticket items, but staying committed and consistent doesn't interrupt the compounding effect. So again, market different from the economy. So they're being cautious with their economic decisions, but you got to have that courage to stay convicted into your investing.
Yeah, I mean, look at what happened through Liberation Day, right? I mean, there's some volatility, but if you're staying invested with your 401k, you acquired shares at what could have been a generational trade. Look where the market is since then. We saw that during COVID as well.
Absolutely. I mean, that opportunistic investing, I guess another C would be cash. I mean, you got to have some cash in there. You can't let the inflation bed bugs bite, but when you have an investment portfolio, cash on the sidelines to have protection, like a moat for your decisions. When people want to make career changes or holidays or those opportunistic investing or just lifestyle choices, you have to have some cash on the sideline so you don't have to react if you get some headwinds in the market.
Well, we learned that during COVID, right? Yeah, I mean, that was a real-time lesson for sure. Max, it's interesting, you were mentioning before, why are we getting the rate cuts, and the underlying message is what's key here. Kind of reminds me of the IPO market as well. Is it because investors have to exit, right? Is it, are the fundamental reasons there, or is because to what Preston was saying before, it's getting hard to raise capital in the private space.
It is.
You're gun shy for that reason.
It's getting harder because that's been growing longer. Those private valuations have gone up, and it's really in kind of the mega caps that are staying private longer. We're seeing there is demand. We're seeing another more deals this week, 20 times oversubscribed. I think it's starting to get. We hear a lot about valuations, how valuations are stretched, especially for the large caps, but they keep working. So people are staying invested in it. So I think they're looking for something else to invest in, but that has the opportunity to outperform. Anytime you've rotated out of the large caps and you try, like we've talked about plenty of times, go that small cap, long small cap, short the mega cap, kind of on that convergence trade, it's underperformed, continued to outperform. So it's really hard for investors to get out of their winning positions, even though valuations might be stretched. They say, well, this is still working. It's still working. It's hard to go out to buy something that hasn't really performed, and the new issue market gives that opportunity. We've seen incredible demand for these new issues. They're not exactly the mega caps, but they're large offerings, so there is a real business behind it. They're successful. Most are profitable now, so as they're coming public, it's not so much the growth at any cost story. There is a profitable business there. So I think there's demand for new issues and for other assets. It's just very hard for investors right now to give up those winning trades. If you've been in this AI cycle, GPUs, cloud, it's still working. So until it really starts to turn, and not just for 3 days. I don't know how many times we've seen it. We get a 3-day sell-off, and it's like, well, is this it? Is this the end of the trade? And then a week later, you're back to all-time high. So you've been incentivized to stay in those trades and not rotate out, because anything you're rotating into, unless you're going into the commodity space, you're really not getting that outperformance like you've seen elsewhere. So I think that's where the demand for new issue, and we've all seen a lot more demand from retail for new issues and IPOs. Previously, they really got no allocations. We've started to see larger real companies that are allocating more to retail, and there's the demand that potentially was missing on the institutional side. Retail's really starting to pick that up and really participate in that. And again, they're getting access to it now because of the way trading has basically changed over the past 3 years.
And it's interesting because the crypto new issues are the ones that have been allocating to retail investors, which I think is the ethos of the space itself. So I find that encouraging to keep it in the public markets, but also be mindful of the retail investor. Ruth, we haven't spoken about this, but tariffs, has there really been any disruption in the gold markets? Has it, and my other backup question to that is, how does LBMA data play a role when trying to make these investment decisions?
Well, I think the tariff story has really been on again, off again, and it was really quite dramatic at the beginning of this year, and then most recently back in August, when there was decisions that came out from customs. So at the beginning of the year, there were concerns about tariffs and whether or not bullion would be exempt. So a lot of investors started moving metal across the water into New York from about November in the lead up to inauguration. I think whilst a lot of people had hoped there would be exemptions, there was a lot of uncertainty. And I think to your point, there's still a lot of uncertainty in the economy and the outlook generally, which tends to be very positive for gold. But when there was also a lot of conspiracy that London, which is the biggest physical market for gold, was running out. So when numbers came out that LBMA has been publishing now for about 7 years, you could see that the stocks had gone down, but still very solid numbers. And it's something I would say to anyone who's looking at gold for the first time, look at the LBMA trade data, powered by Nasdaq, in terms of everything that's out there as well as the holdings. And that's how you can really trade with confidence in these markets.
So how would you correlate gold to crypto?
So it's a funny one because, it's like the world's oldest currency and the world's youngest currency. They should have nothing in common, but actually they attract a similar type of investor who doesn't necessarily want big state, doesn't necessarily have confidence in traditional assets. And I think we've been watching with interest how some of those things have been coming together. So El Salvador, which I think was the first to make Bitcoin legal tender, has actually upped its holdings of gold. And Tether has been very noisy in the gold market, talking about it's got the stable coin, but fully backed in bullion. And I think there's some announcements coming up in terms of further ambitions. So it's surprising, but I do think that there's synergies there, certainly from investors who are seeing that uncertainty and wanting to have some hedge against it.
Preston, are you, from the clients that you're advising, are they looking to dip their toe into crypto at this point? Are they a little bit more conservative? Or how do you, from an advisor's perspective, how are you?
I get a giggle like everybody else. It's funny, ironic, about the conflation of TradFi and traditional finance and decentralized finance, because they are wanting that. Now, decentralized finance is now starting to take off. Now this has some institutions take it. Now we've had some laws, take force in now. So they're conflating it. They're converging, I guess, now is the word. So they're coming hand in hand, right? So they wanted some backing. Also, I think the commonality there is the mindset of, wanting some confidence in something, right? Good monetary policy can't offset economic policy, right? So they're battling. So they're looking for some sort of confidence. Where's my confidence, and where do I invest in it? So therein lies the mindset. So we have to constantly give the information, see where the goals are for the individual, right? And I've got to go to age-old additive is, here's your core portfolio, put some of these commodities, the crypto, and your best idea as far as your stocks into your side pocket satellite portfolio, and use that.
Yeah, because there has been a significant uptick with retail investor demand for alternative investments,
Yes.
private markets in general.
Yes, absolutely. Again, they're looking for best ideas. What's next? I mean, because their confidence has waned in the market space because of this battle. Like, for instance, we have the president saying, "Oh yeah, there's going to be a big 50 basis point," cheering for that. That necessarily may not be the call for that. So the people are not really confident in maybe the rawness of it, and maybe the economy in of itself, right? So they're looking for what's next. Is it gold? Is it silver? Is it AI? Is it something alternative to where I can put my belief in? I think that we need to remain consistent. That's what I tell my households, is to remain consistent in the market with those C's that I'm talking about. And then if you want to have your convictions, another C, man, I'm hitting the mark.
It started the kids young, compounding interest.
Right, have
yes.
your convictions in your side portfolio.
Yeah, and Max, to wrap up here, since the intelligence desk is always speaking to Nasdaq listed issuers, any common themes that you're hearing from the companies that you talk to in terms of how they're perceiving the environment?
I think there's still uncertainty out in the market in terms of policy and what's coming out of the Washington, but they are more secure in their business. We've been in this higher rate environment for a number of years now, and companies have learned to adapt. It's been the biggest focus, I think, over the past 5 years is adaptability. They've seen 0 interest rates. We've seen mortgage rates up at 7%, with treasuries 4.5%, 5%ish. So I think they've adapted to kind of the new environment and continue to operate. And supply chain and ensuring that the business is in the right spot, they've kind of simplified a bit in the sense of we don't want to have so many different factors filtering into our business that we can't control. Kind of control the supply chain a bit more, get all your ducks in a row so you can manage through these environments. You're not seeing big layoffs anywhere. So it's rate cut would be nice, potentially helpful, but it's not necessary for a lot of the companies now that that I'm speaking with, because they've kind of got their house in order and able to manage through this cycle, and because they're able to use their stock a lot of the times. To issue secondaries, don't have to really tap the debt market where you have that interest rate expense. They're able to manage it with their stock because a lot of them have seen their assets, their stock appreciate. So
Yeah, I mean, the second quarter was quite good.
Yeah.
But think about it this way too, even though you're not seeing as much hiring, perhaps they're trying to understand what type of positions and skill sets do I need to hire for. So it doesn't mean they're laying off. It's just they need more visibility into what that's going to look like.
Absolutely.
Well, I mean, this economy, the way that it's laid out, it's not very confident boosting for the consumer. It's great for companies. I mean, wage growth, tepid. That's good for the bottom line for companies. Buybacks, like you said, financing, that's great. Stock buybacks, that's great. And also cuts, cost of capital. That's also great. So
Which is so counterintuitive, right? Because at the end of the day, you want to make sure that you have people employed, because the circular economy, they are going to be the ones that put the money back into the economy. So it just feels like we're at this inflection point, if you will, as we learn to get some visibility. Appreciate everyone's insight. Thanks for joining us on Trade Talks. Thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.